Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 249th VideoCast podcast for the week ending July 25th, 2024, live from San Francisco. Very excited to be here. So we're going to get right down to it. A couple family updates, and then we'll go through it. Got to celebrate my birthday a day early on Sunday. That's me with Mimi. That was fun. And then this is the green room of Yahoo, who like the behind the scenes photos. We have a lot of new people joining us every single week, so I don't take that for granted. And I go through these. You could see Shauna Smith there doing the show live, the teleprompter there, and Madison is a new host over at Yahoo. This is the back office at Yahoo with all the people in the office there. And this was an interesting one. This is a picture of me with Jim Rohn, who is one of the greatest personal development teachers of all time. He actually taught Tony Robbins in his 20s, and he taught me in my 20s, by the way. So we're going to get to this because someone sent out a tweet this week, and it reminded me of my time with Jim in the 20s. He's an absolute legend, and you get to see a photo of me when I was late teens, early 20s, which is kind of mind-boggling. Moving on, we are at the Junior Olympics for Mimi and Annabelle, and they have had a phenomenal start. They've won both of their first games, and we've divided and conquered. Caitlin took Annabelle to her games, and I took Mimi today, and then we'll switch tomorrow. But it's been hot out here, so I'm a little bit, it's been a long day. And they pulled off unbelievable because of their goalie was unbelievable. You know who you are. And the teamwork was unbelievable. So we're just so proud. The second game was really hard against San Diego Shores, and they won 8-7 by one goal and got the job done, which was just phenomenal, which allowed us to leave Diablo, whatever it is, university or something, early and not have to wait there till 7 o'clock. So that's me with Mimi. That's the Junior Olympics 2024. And we're staying down here all the way in Redwood City near Oracle headquarters. What's pretty cool about Oracle headquarters is they have in their water in the front an America's Cup boat, which is pretty cool to see. Got to play Presidio right off the plane. Only 9 holes. I had work to do, but beautiful track. Shot a 42, by the way, which was also pretty decent and respectable. And by the way, which was nice, coming off a strange week, 82 on Friday, and then I shot 90s on the weekend, but my index got down to 11.4. It's 11.8. So we're making progress towards that 9.9. We're going to see if we can do it by the end of the year. And this is the par 3. Many of you that live out here know it. I landed just short on the green. I didn't make the birdie putt. It was about 9 feet, but I was dropping putts. I wasn't hitting the ball well, but I was dropping enough putts to shoot 42 on a brand new track that was super windy. Is pretty excited. First thing we're going to talk about is I did a ton of media before we jumped on the plane. And those of you who are new don't know that since June, we've been talking about a violent, abrupt rotation that would come, and people would look at me like, nah, it's not going to happen. Mag 7 is just going to keep going and keep going. I said, nah, it's going to happen, and it's happening like nobody's business. So we're going to talk about that. And first, I want you to tune in. This was Allie. First off, I want to thank Sydney Freed. I want to thank Sarah Smith and Alexandra Cannell for having me on. We're going to listen in here.
All 3 major averages trading in the green a little more than 90 minutes into the trading day. Investors are tracking a slew of big tech earnings as we've seen a recent pullback in some of those larger cap names. And we have seen a rotation for many into small caps, with the Russell 2000 continuing its upward trend today, up more than 10% in the last month. Joining me now in studio is Tom Hayes, Great Hill Capital Chairman and Managing Member. Tom, thank you for being here. We do know you're bullish on the small cap trade amid this market rotation. So what's fueling that positive sentiment for you?
Well, there's a lot of skepticism still in this rotation. Everyone thinks it's going to be a fake out again, but I'm going to tell you why. The dreaded words, this time it's different. There's actually a fundamental underpinning in why the unmagnificent 493 have legs for the second half, and why we believe the Magnificent 7 are actually going to start to underperform a little bit relative to the 493. And the number one underpinning is earnings composition. So we started out the year, the first quarter, Magnificent 7, 50% earnings growth, the unmagnificent 493, negative 1%. So they should have underperformed, right? Well, now that is shifting. And by Q4, you're going to have 19% earnings growth in the unmagnificent 493 and 17% earnings growth in the Magnificent 7. So decelerating earnings growth for the Magnificent 7, accelerating earnings growth for the unmagnificent 493.
So what areas of the small cap trade do you think are undervalued at this point? In other words, should you just be buying the index, or should you be a little more selective in your approach?
You can certainly buy the index like IWM. We have an auto parts maker called Cooper Standard, which we like. There's a huge amount of operating leverage. You're looking at real businesses. And what you're going to find in the small cap world is a lot of cyclical businesses. When you see the Fed cut, which is the second underpinning for this violent rotation, there are a few groups that outperform. Number one is small caps. They outperform by 11% over large caps within the 12 months after the first Fed cut. Cyclicals, so you have a lot of cyclicals within small caps. International stocks start to outperform because the dollar weakens on the Fed cuts. And REITs start to outperform. So those are the four areas. And then if you look at institutional positioning with the four most crowded trades, you have what? You have short China stocks, which is international. You have short small cap stocks. You have long Magnificent 7. So when everyone is crowded to one side of the boat, it makes sense to start to ease into the other opportunities in the market.
So quite a few trades that will benefit from that easing cycle. Are you in the camp that we're going to start seeing cuts in September? You think possibly July?
The market's telling us, 95 to 98% chance of the first cut in September, which would imply a second cut in December. If they do it that early, Alexandra, I think they may be able to get away with just 2 or 3 cuts. If they wait too long due to political considerations or other, I think you're seeing a deterioration enough in employment and in inflation. If they wait too long, it's going to cost them too many cuts. So I think they kind of know this from history. The market is assuming that they know this from history. And if they go in September, I think we're in good stead, for sure.
Okay, that'll be something a lot of investors will be keeping an eye on. But you also are bullish on 2 names in particular, Disney and GXO Logistics. 2 very different companies, but I want to start with Disney. This is a company that I cover closely. Yes. Where do you see the pricing going for this, and why are you bullish?
Yeah, so this is really out of favor right now. We break it up as some of the parts evaluation. So basically you have the parks and the consumer products and experiences. That business alone will do $10 billion of EBIT, okay, which implies $80 a share. The stock's trading around $90, $95 right now. So you're effectively getting 0 value for Disney Plus, 0 value for ESPN, 0 value for the theatrical releases. So if you look at their streaming business relative to Netflix per se, Netflix got 277 million subscribers. Disney Plus has 153 million subscribers. In the case of Netflix, you're being ascribed $277 billion. In the case of Disney, you're being ascribed $0. So we think that business is going to do $15 billion of EBIT over time, which implies that the stock can double over the next 3 to 5 years. And why do we feel confident is because ValueAct, the activist investor, is now involved, and they turned around Spotify, which you saw the earnings this morning. They're really good with subscription businesses. They turned around Salesforce, and they turned around the New York Times. And if you can turn around the New York Times, you can certainly turn around Disney. So we're excited about that opportunity.
Okay, bullish on Disney, and then GXO, a more cyclical name, but you think the timing is right?
Timing's great. So you had a huge amount of pull forward, all products during COVID. Everyone was buying everything from home. Then it was the revenge travel and services became the forefront. Now we're moving into a more balanced environment. They do outsourced supply chain, logistics, reverse logistics, and this is a Brad Jacobs company, and everything he touches tends to turn to gold. Whether it was United Rentals, if you invested $1 million with him then, you made $47 million over a number of years. If you invested in XPO Logistics, if you invested $1 million, you made $31 million. So we think they're expected to nearly double EBITDA by 2027, which would imply the stock can go up materially from here. But I think when they get to that level of EBITDA, because the growth rate is higher, they're going to get multiple expansion on top of it. So I think there's a lot of upside. They really operate kind of in a duopoly, in a fragmented business with DHL. And they're better, they're stronger, and we're going to get rewarded for that.
All right, two names to keep in mind moving forward.
Thanks,
Tom Hayes, Great Hill Capital Chairman and Managing Member. Thank you so much for joining us.
Thanks, Alexandra. I appreciate it.
Coming up.
And we're back. So that is the first segment. Then I had an amazing opportunity to be on Bloomberg Radio. And this segment was with Brian Curtis and Doug Krisner. I want to thank Brian and Doug, as well as Bonnie Au, for having me on. We go into further depth, and what's beautiful about each of these segments, they ask different questions. It's on the fly. We got into currencies a bit more here, which you're going to want to pay close attention to because that's a key component of our thesis, as many of you know. So here we go.
And joining us now on the program is Thomas J. Hayes, Chairman and Managing Member, Great Hill Capital. Thomas, Doug mentioned it, and Tom just reported on it. Earnings will be a major focus coming up. I heard this morning that if you strip out Tesla, the Magnificent Six is expecting earnings up 30% year on year. The other 494, about 5%. What do you choose from?
Well, you know, this is the reason that we see a lot of skepticism around this violent rotation that started about a week and a half ago, Brian. A lot of people think this is going to be a fake out, but actually what you're seeing is a deceleration. So if you thought that difference was big for this quarter, back in Q1, it was 50% earnings growth for the Magnificent Seven and negative 1% for the unmagnificent 493. And by the end of the year, fourth quarter, it's going to completely flip on its head. You're going to see 17% earnings growth for the Magnificent Seven and 19% for the unmagnificent 493. And that's why we think this rotation is real and it is durable because it's underpinned by earnings and Fed cuts coming to a theater near you.
So, will that be amplified when we get the guidance from these big tech companies?
I think so. Look, they've had a tremendous amount of CapEx. They're all racing to hoard the GPU chips. And, you know, you saw the article, the $600 billion question. Where are they going to get the revenues to support all the spend on GPUs that they've all been trying to hoard from NVIDIA and pull forward all of that demand? The revenues simply don't support it. So I think that's going to support the deceleration story, albeit there'll be great earnings and there'll be great earnings growth. It will just be at a lower pace while the rest of the market goes from negative earnings growth back into positive earnings growth. And so what we could see is the indices, market cap weighted like S&P 500, more subdued because the heaviest weights will be consolidating, while under the surface, there'll be tremendous opportunities to make money.
Yeah, so it'll look like an average day, but you actually made money. However, your thesis, while I love it, if it turns out to be true, it's quite dependent, don't you think, on growth holding up?
It is. There's no question about it. I mean, even if you look deeply under the surface at small cap earnings growth, which have had really not strong earnings growth, 4.1% expected for this year. That's going to accelerate up to 17.7% next year. So that is a sign of growth. And the underpinning of this that not a lot of people are talking about, Brian and Doug, is the destocking cycle is about over. For many companies, you've heard in the last 1, 2, 3 quarters, that's done. And the restocking cycle and the CapEx cycle is just picking up. And then you have all the reshoring to support it. And manufacturing, which has been in a clear recession for over 2 years, is now starting to show signs of buoyancy. So all of these things under the surface point to healthier markets, not just controlled by a handful of stocks like we saw in the first half. 5 stocks generated 60% of the S&P returns.
So when I hear that, then I'm wondering, why should the Fed be aggressive in cutting interest rates?
Well, you do have slowing in the labor force, which is problematic. The key here is if you let it go too long, it becomes too costly to fix. So we're of the view that if they move in September, as the market consensus is pointing to 98 or 100%, depending on the day you look at it, chance of a cut. It may be more of a mid-cycle soft landing where 1 or 2 cuts could be sufficient, maybe 3 cuts. If they let it go much past that, I think the acceleration in the softening in the labor market and the deceleration now that we're seeing some of the auto insurance come down, owner's equivalent rent start to catch up on a lag basis. Inflation is a much easier problem to solve than deflation. Deflation is costly, it's long lasting, it hurts a lot of people. Inflation, if they move too early, they could always hike again. I know they don't want to do that, and I think the probability of that is extremely low. Hike early, you won't have to hike as much, and let's keep things on steady footing.
Now, we know what happens when too many people load up on one side of the boat. At some point, they have to rush to the other side, and it really causes a lot of sloshing around. You say the 4 most crowded trades are long the Magnificent Seven, short yen, short China, and short small caps. So would you flip all of those on their head, and we'll see how bold you are if you're ready to short the Magnificent Seven?
Well, I wouldn't short the Magnificent Seven, but I do think what's going to happen is they're going to underperform relative to the unmagnificent 493 that are just catching a bid finally because their earnings growth is starting to support that bid. So I think you're going to see some underperformance in those crowded trades. Some of them will probably cool off, but on balance, maybe consolidate performance for 4 to 6 to 9 months.
Which of those four look best to attack? Would you say maybe it's shorting small caps, that's a good one to flip?
Oh, 100%. You want to be long small caps for the next 6 to 12 months. And history supports that out. After the first Fed cut over the next 12 months, small caps outperformed large caps since World War II by about 11%. So history is on your side with long small cap. I think China equities, we didn't get the boom we wanted out of the third plenum. However, we got the surprise cut this morning. I think more to come on the property front, and the valuations are simply too cheap. It's been a long wait for a year and a half, dead money. The market's been going sideways. You're seeing some smart money selectively start to filter into highest quality China equities. Mm-hmm. I think small caps is an easier trade. And then short yen, you're going to see potentially some intervention. And with the Feds starting to weaken on a relative basis, I wouldn't be short yen in the hole here either, to be honest with you.
So maybe I'm going to be short the dollar, particularly if, the Fed is going to cut, in your view, maybe as many as 3 times. And if there's going to be a bit of short covering in yen because of it being a very crowded trade, and at some point the BOJ is going to move and tighten conditions in Japan, is it wise to be short the dollar at this point?
Well, I think you're right, and I wouldn't play it explicitly through short dollar, but I would play it through what benefits from a weakening dollar. You're correct on direction, but what's the best way to express it? We like international stocks, which have underperformed relative to U.S. stocks. And then as it relates to rate cuts, we like small caps will benefit, cyclicals will benefit, and REITs will benefit, interest rate sensitive. So I think the biggest way to play the weakening dollar over time is going to be to have some international equity exposure, which really, if you're biased by recency bias, where international has just underperformed for so long, if you zoom out for the last 50 years, you've had some meaningful periods of outperformance, and I think we're right on the cusp of one right now. The band has been stretched to such an extreme level, it might be time to take action.
All right, I got $1 million to invest. Give me your number one unassailable back up the truck bet.
Oh my goodness, this is tough. We run a concentrated portfolio. I can't give you one, but I'll give you a couple of the names that I feel very confident about, because we can't predict which ones are going to pop first, but we know if we use a reliable framework and buy quality when it's on sale over time, we're going to get full value.
Quickly, Thomas, quickly.
We like Disney. Okay, that's undervalued. You're basically paying for the parks and consumer products and getting the TV, the theatrical, and Disney Plus for free. We think that can go from 94 to 150 plus over the next few years. And GXO Logistics, there was a pull forward on products, then to services. Now it's becoming more balanced. Their business is going to come back. And we're back. And then finally, I was on the BBC, and I was supposed to talk about the violent rotation, and instead I I followed Kamala Harris after the political news, so it became a political interview, which, it's not what I enjoy talking about, but it was salient to the markets, so we're going to listen in here.
Meanwhile, donations are pouring into the Democratic Party and Vice President Kamala Harris's campaign after President Joe Biden quit the presidential race and endorsed Kamala Harris. Collectively, they've raised over $100 million. But Harris still needs to win the Democratic nomination at their upcoming convention next month. Well, does any of this change the scenario for investors? Well, let's put that question to Thomas Hayes from Great Hill Capital, who joins me now from New York. Thanks very much, Thomas, for your time here on Business Today. I'd just like to start by reflecting on what we heard from Kamala Harris, who was speaking just a short while back, and we were broadcasting that and talking about that. What are to be the likely reactions market-wise to what we just heard from Kamala Harris and how she's starting her campaign?
Well, Aruna Day, I think we saw a preview of coming attractions today. We've had this pretty violent rotation out of the Magnificent Seven, the large cap growth stocks, into small caps. And that was reversed over the weekend when we saw that Joe Biden was stepping down and Kamala Harris was taking the reins. And what the market said to that was, okay, it had been a foregone conclusion that probabilistically former President Trump would win in November. Now those odds are slightly narrowed. And as a result, we saw tech stocks back up. I do think this is a fake out counter trend rally, Aruna Day. And the reason is because this rotation is not just political, it's actually underpinned by a change in earnings composition. The earnings growth for the large cap tech stocks is decelerating, while the earnings growth for the small cap and cyclicals, the other 493 S&P components, is actually starting to accelerate.
Right. And it's still early, Thomas, but Kamala Harris, the Democrat favorite, is yet to really outline her economic vision. Are we likely to see economic policies being carried forward from before? Will investors have any concerns?
Well, it's going to be Biden part two. There will be no material change in the outline or the execution. What I think the market cares most about, empirically looking at the historic data, is are we going to have a mixed rule? Meaning, will the House and Senate and executive branch all be one party? The advent of Kamala Harris into the picture speaks to a probability that even if the Democrats don't win the executive branch or the Republicans win the executive branch, it's no longer a foregone conclusion that it will be a sweep. And what the market's like, whether you have a Democratic president or a Republican president, is gridlock. They like to see checks and balances, is kind of the culture of American politics and the markets. And stock markets in the US do better when one party does not control the executive, the Senate, and the House of Representatives. And I think what we saw with the change is that the probability of a sweep has narrowed, and the market kind of likes that.
Very briefly, Kamala Harris has previously worked with Silicon Valley, which has thrown support for Trump. Recently, we've heard Elon Musk. But will Harris's bid sway tech investors towards the Democrats, you'd say?
It's very hard to say. I think that people who have publicly made endorsements are probably going to stick with their public declarations and their monetary declarations. It certainly does move things in a kind of more centrist point of view, meaning there are now more options for people. They felt perhaps several days ago they had less options when they go to the poll in November. But the odds are still similar to what they were prior to the weekend. And this is early days. So we're going to see a lot of change and a lot of movement in those polls over the next few months. As it relates to stock market performance, though, what the stock market wants to see is gridlock. So markets tend to like when politicians can do less, not more.
All right, Thomas Hayes, thank you very much for joining us here on Business Today.
And we're back. Want to thank Mariko Oy, Zarina McDonald, Ibrahim Subramaniam, and Arunodey Mukherjee, the host, for having me on. Also want to thank Chibuke Ogu, who had me in his article on Reuters about the rotation. And we'll start it off with a quote of the week. And this quote could never be more salient from Peter Lynch, one of the legends, there is always something to worry about. Avoid weekend thinking and ignoring the latest dire predictions of the newscasters. Sell a stock only because the company's fundamentals deteriorate, not because the sky is falling. And that's what we keep reminding folks with. We had these amazing opportunities when we picked up Google and Amazon in October 2022 and March 2023, and those are up double pluses. And as you know, those of you who've been listening, we trimmed back meaningfully a few weeks ago on the basis of this violent rotation, which is now kicked in. And I think it's going to be a very similar situation to Intel, where we were able to buy sometime back at 25, sold 2/3 at 48, and then we were able to add back at 29, 30, 31. I think we're going to be able to add back the meaningful part of the position that we took profits on in Amazon and possibly Alphabet certainly now much lower levels than we sold, but I think even lower levels, and we're pretty excited about that. So this is critically important, and we're going to spend some time on it as we do every week. This was a picture with Jim Rohn from 18. And the reason and this was Jim Rohn taught me. He also taught Tony Robbins. It's a picture of me and Tony Robbins a couple of years back at a hockey game. Ran into him, and we kind of shared a couple stories about Jim Rohn, which was pretty cool. But the reason I brought this up is because this guy, Tim Denning, did an incredible thread on Twitter. And I think at times like this that many of you who are not clients are probably excessively overweight Mag 7 and getting hammered in your indices. And if you're in any indices, your market cap weight, so you're feeling the pain of that, and weren't able to take advantage of the rotation. If you are clients, you know what we're in and why we're positioned and why we're benefiting from that. I mean, it's unbelievable on these scary days where you see the Mag 7 collapsing and a great portion of our portfolio is green and we're green on the day. It's like, it doesn't get any more exciting. But look, it's what goes in and positioning, and now everything that we've been setting up and laying the foundation. It's kind of like when you think of a skyscraper, they dig below the surface for a year and no one understands all the work that's going on, because when you look from street level, it looks like they've accomplished nothing. And then once that foundation is laid and the work has been done and all the heavy work, as the floors go up, the more floors that go up, the faster and higher it goes. And it's going to be the exact same thing with this thesis, and now starting to play out, is that when it goes up so fast. So nothing for a year you see in terms of under the surface work. And then all of a sudden you go back, you see 1 level, 2 level, 10, and then 100 levels. It feels like it took less time to build 100 levels high above the earth than it did to lay the foundation below the earth. And it's pretty damn exciting to see the blueprint and the architecture all come to life, and that's what we're seeing. So Tim lays this out. Jim Rohn is the original godfather of self-help. At 31, he became a millionaire. Back when $1 million actually meant something. This was like the 50s and 60s. He died in 2009 with a net worth of $500 million, 6,000 events, 4 million people, 17 books, millions of copies. He trained Tony Robbins to be who he is today. And he identifies 11 key parts. There's a lot more to Jim Rohn than these 11 key parts, but I would suggest to those of you who are younger, and I know we have a good demographic of that, and some of you are middle-aged, and some of you who are senior in your careers and lives, I'd still recommend you listen to Jim Rohn, because the excitement in life is setting up new projects, and whatever that is, no matter how successful you've already been, the joy is from going for something new. And he did a tape series, you can probably get it on YouTube for free now, called Challenge to Succeed. And I mean, in my 20s, I must have listened to that 2,000 times. I mean, and it completely changed my life. So I'm sharing this with you guys. It's not what we normally talk about, but it's the foundation that gave me the persistence to get to what I've been able to do, and I'm very, very grateful for. First tenet that Tim outlines here is, quote, don't major in minor things. And Jim was famous for this. So you can go through all of these and get to it. And he has little videos here. Second lesson was learn to work harder on yourself than you do at your job. Okay, personal development, getting your emotions under control. We talk about ice in the veins as it relates to investing. Number 3, we will all must suffer from one of two pains, the pain of discipline or the pain of regret. It's hard to become super successful. It's also hard to become a super failure. It takes just as much effort to not be disciplined as it does to be disciplined, and the outcomes are, eons apart. 4, don't wish it were easier, wish you were better. Okay, when you're tempted to whine, just say, okay, where's the gap between my current skill set and the skill set I need to make my dreams come true? I think there's a lot of depth to this simple line. 5, formal education will make you a living, self-education will make you a fortune. It's like Warren Buffett says, once you're over 120 IQ points, or I think he even said lower, maybe 100 IQ points, then each additional 10 sometimes works against you, particularly investing when people overthink things and their minds are so active that they can't just sit on their hands once they've done the reasonable analysis. Stay update. Are the cash flows going up? Are the revenues going up? Are the earnings going up? Not what's the stock price doing today. That's where they get caught and do it. Number 6, if you really want to do something, you'll find a way. If you don't, you'll find an excuse. And that's very simple. You either have reasons or you have results, but you can't have both. 7, it isn't what the book costs, it's what it'll cost you if you don't read it. So if you're not educating yourself, if you're not reading, you're not going to be able to compete at the highest levels. Number 8, successful people have libraries, the rest have big screen TVs. That's an emphasis on that. Number 9, if you're not willing to risk the unusual, you will have to settle for the ordinary. There's no way around that, ladies and gentlemen. If you want outperformance in the longer term, you have to accept some short-term volatility, and that's just the way it works. And number 10, you don't get paid for the hour, you get paid for the value you bring for the hour. If you got paid for the hour, you could just sit home and they'd send you your money. Number 11, without a sense of urgency, desire loses its value. And those are just some summaries. So as you kind of dig into the rabbit hole of Jim Rohn, and now that he's passed, most of his stuff is for free on YouTube, I think you're going to get exceptional amounts of value. And for those of you who listened to it in the past, and which likely means you're already super successful, the refreshes are well worth their while. Charlie Munger, the big money is not in the buying or selling, but in the waiting. And Peter Lynch, everyone has the brain power to make money in stocks. Not everyone has the stomach. If you're susceptible to selling everything in a panic, you ought to avoid stocks and mutual funds altogether. So this was today's end of market, which has been the theme for the last few weeks since we talked about being on the cusp of a sea change multiple times. And what do you see? You see Magnificent Seven down, and you see the rest of the market up, and that's been kind of the theme. So we've got a bunch of data to come here. Here's initial jobless claims. The reason I keep bringing this up is because we want to know when the Fed cuts. We want to make sure that they don't cut too late. And tomorrow we get PCE inflation, which is beautiful. Today we saw solid GDP at 2.8% despite consistent disinflation. This is what we call a perfect soft landing. And if we get, there's a lot of chatter that July could potentially be on the table. We would really need to see an aggressively weak inflation number to force their hand on that. But the fact that that's even in the dialogue at this moment is very, very promising and supports the continuation of this thesis. So, right here, they've got enough on the jobs market to start to cut. If they wait till September, they wait till September. But now the market is acting in accordance with that, and that's what we've been waiting for. We saw Russell start to take off here, small cap starting to see. And so you can see that 4-week highs, the last time that happened was the lows just after the lows in 2020 and just after the lows in 2018. If you remember automatic pilot, when Powell blew the market off the cliff on Christmas Eve, once they announced that they were going to flip that and he was not going to be on autopilot and the market flipped, you saw this level of 4-week new 4-week high lows. It's a breadth indicator for the Russell 3000, and that pointed to good things moving forward. S&P 500, a Magnificent 7 in tech earnings with the trend. It's toward the top of the trend. It usually doesn't sustain this channel, and that's why you're seeing what we've consistently been preaching. This is not like I hope the other 493 works. This is rooted in earnings power and cost of capital. Deceleration in Mag 7 earnings growth. And what did we see that with? We saw it with Alphabet, that their CapEx spend was too high relative to the revenues that CapEx spend generated. And they said, we're going to do more. And then on top of it, they said, well, why don't we just throw another $5 billion at Waymo after they weren't going to do that. So all of these Mag 7 you're going to see are spending all this money on chips that in no way, going back to the article, the $600 billion question that we covered many weeks ago from from Sequoia. Look it up. Just Google Sequoia or perplexity.ai, Sequoia, the $600 billion question. And you'll see that they've all been hoarding these chips, but there's no possible way that they can generate enough revenues to support the CapEx that they've already done. And there's $600 billion of missing revenues to do it. And they talk about SaaS margins and everything else, and we've covered that. Continuing jobless claims, again, going up. Philadelphia Fed manufacturing moving in the right direction. Remember, we were in a 2-year manufacturing recession. It's starting to recover with the destock, restock, and you see fits and starts in different regions aren't as good. And here's the mega caps again announcing more CapEx, 48% spend. Look, let them kill each other. We want to be the arms dealer, which is why we like Intel. Japan CPI high. This is next week. We should get the hike from the Bank of Japan. By the way, it's hot out here. Those of you who are in San Francisco, is like 85 all day. So I've been baking in the sun watching all these games. So just bear with me this week. I'm drinking some caffeine to deliver to you guys today. But, okay, Japan's inflation rate rose for the second consecutive month in June. Core CPI gained 2.6%, which means if they move tomorrow, that's going to be next week, that's going to be a further unwind of the carry trade, which had all been concentrated in the most crowded trade, which was long Magnificent 7. And where's that money going to go? It's going to look for value all around the world. Weakening dollar will get the international. You just got to be patient. All you have to think about with the international is, are the companies you own increasing or decreasing free cash flow per share? Are they increasing or decreasing revenues per share? Are they increasing or decreasing earnings per share? Is the multiple still cheap? And then you just wait and play the time arbitrage game. While everyone gets faked out by price and gets all depressed and sells their stock, you just pick it up to the extent that you're available to and let them go make excuses. They'll have their reasons. We'll have our results. And that's how it works, okay? Cumulative net purchases of Japanese stocks by foreigners. So you can see here, there's a seasonality to Japanese stocks, and we're at the peak. We've been talking, there was such a fervor of excitement around Japanese stocks, and I was like, guys, their demographics just simply doesn't support it. This is just hot flows from China. When China rights the boat, it's going to come back out of India. It's going to come back out of Japan, and you watch. This other move by BOJ is going to be another key catalyst, and you're going to see money start to flow back into China, weakening dollar, all the things that we've been laying out, the foundation under the surface. You can't see it, but once that first floor goes up, you're going to look back 3 weeks later, and you're going to be 50 floors up, and you're going to look back 6 months later, you're going to be 100, and you're going to say, oh my God, took a year and a half to build the foundation, and in 6 months, we've got the greatest skyscraper in the world. Here, private clients bought Japan, of course. They're all crowding in at the top like lemmings. And small cap funds see second weekly largest inflow ever. So this is why I said last week we were going to have a check back, because all the people chased the small caps after it was up 11, 12% in a couple of weeks. We got a little bit of that. But this is just the beginning of the move, not the end of the move, as you saw in 2020. And so we like what we're seeing there. Moving on, profits recovery for small caps, you start to see in Q3 in earnest. Q4, and then it's the year of the small caps in 2025, which we've covered. 4% earnings growth this year, 17 next year. Where do you want to be? Equal weighted index versus the S&P 500 correlation. These are levels you only saw back in when? 2001, which we cover pretty much every single week, ladies and gentlemen. And what happened? The 2001 period was after the last time you had this level of concentration in the markets. The highly concentrated companies in that case crashed. I don't think they're going to crash this time because they're underpinned with cash flow, but they are going to underperform, as you're seeing, while the rest of the market outperforms. And from 2001 to 2007, we had the greatest rally in value, small cap value, international stocks, emerging markets, etc. And we're setting up for the exact same thing, which is super exciting. This I just kind of pulled up because I thought it was kind of sad. Who do 18 to 24-year-olds live with? 71% are living with their parents, compared to 50% in the 70s. That's sad. Living arrangements of 25 to 34-year-olds, 39% are living with spouses versus in the 70s, 80% were living with spouses in that age range. That's, it is what it is. Now, this is the performance of small caps after the first cut. And what you can see here, small caps on average since 1954 up 26%, mid caps up 24%, large caps up 15%, and which puts small caps at an 11% advantage over large caps. Speaking about the concentration, going back to 2020 period, same thing right now. And then Russell versus NASDAQ reached an all-time low in July and started to turn up, just like we saw in 2001. So history doesn't repeat, but it certainly does rhyme, and it's rhyming like crazy right now. This is the thing that the bears keep leaning on, and they continue to be wrong and will continue to be wrong. They're saying that as the yield curve steepens, we're going to get a recession because we've got a recession when? The last 3 times. They're stuck by recency bias. What they're missing is that the proper analog is 80 to 82 when we had the double dip, just like we had 2020 recession and 2022 recession. 2 quarters of consecutive negative GDP growth we had in 2022. They did not designate it, but it was a recession, just like we had in 80-82. And as the yield curve steepened, we not only did not get a recession, we got a 18-year expansion. So I don't expect 18 years. I expect at least about 8 years right now, but in the U.S., 3 to 5 unbelievable parabolic years in China, and then I'll start to get more defensive. That's demographically driven. We've covered that a million times. Infrastructure beneficiaries are generally trading inexpensively versus the S&P 500 compared to the pre-Great Financial Crisis peak. So construction and engineering, so we benefit from companies like Generac, from companies like Stanley Black & Decker, and others, electrical equipment, construction materials, etc. And then CapEx is a consistent multiple of fiscal spend and is slated to grow, not shrink. We're seeing not only TMT CapEx, which everyone's talking about, but CapEx, which is X Magnificent 7 CapEx, which is going to start to reaccelerate. And this is also relative to the destock restock cycle, which we consistently talk about. Here we're talking about the implied upside based on current valuations with relative value to the S&P 500. They're saying energy has the most upside here, price to operating cash flow. Then real estate has price to forward PE. Dividend yield, real estate, no one wants to touch that. We own the Crown Castle. It's a REIT, tower REIT, cell phone tower REIT. Dividends plus buybacks. That's energy, then which we've expressed through Comstock. Enterprise value to sales, financials. We still have our financials, although we thought about peeling back Citi and Bank of America because we've had such a monster run. The issue that I have there is I hate to sell them ahead of the M&A and IPO cycle picking up, which hasn't even started yet. But I am cognizant of Buffett selling a few $1 billion worth of Bank of America. But Buffett's moves are no longer really Buffett's moves. It's Ted and Todd. And so I still like them, even though I know they're going to correct here and consolidate some of the massive gains we've had in them from really low levels. But we'll tolerate it. And then when there becomes a frenzy of deal activity, M&A, animal spirits come back, rates come down, and they start minting money on the investment banking side, then we'll consider taking profits at, we're already near doubles, but a lot more than that. And go from there. Manufacturing capacity starting to grow after 10 plus years of stagnation. This has been a core part of our thesis. Both industrials and materials relative forward PE versus the S&P 500 is below average. By the way, that also includes 3M, which has had a monster run, and Solventum now has a new activist in the stock, which we got for free, which was spun out of 3M. So not only the price appreciation we've got in 3M, but we also got shares of Solventum. We bought it when no one else wanted it. Everyone looked at us silly, and now it's working. So they're looking at upside here in construction materials, which is the business that Brad Jacobs is going into with QXO. Problem with the Jacobs thing is he's getting, took a brief look at it. I'm cuffing this here, but he's getting like a $25 billion valuation, or he's raising money at a $25 billion valuation, which is probably cheap relative to what it's going to be worth, but they haven't done one deal yet. So what I'd like to see is they go raise a ton of cash and, the market sells off, or they think they don't like Brad Jacobs' first deal, and I'll buy it even cheaper than they did the secondaries, or I'll miss it, but I'm not buying up. So Bank of America indicator, we saw that. Consumer confidence still subdued. This is what you get out of a recession, which we had in 2022. You see it here in 2009, etc. Non-farm payrolls converging with pre-COVID average, so they're going all the way back to normalized levels. Real wage growth less than 1%. Again, these are the things that Fed wants to see. Consumer deposits still elevated at 17.6 trillion. And China cut rates not once but twice this week. Surprise cuts after they kind of under-delivered on the third plenum, but they're still cognizant of their need to take action. And we're going to talk about more action that's expected before the end of the month. Retail sales do not suggest the customer is pulling back. You saw them break out here. And then see continued upside. So this is from, it looks like Bank of America, and they lay out the 20-year consolidations by 20-year expansions that we've been talking about for 3 years. So they're finally on board, and they're basically saying we're halfway through the cycle, like we've been saying since 2020. And everyone was like, no, we're going to hell in a handbasket. I said, no, look at history. Merrill, still a long way to go to 8,000 on the S&P compared to two previous secular bulls. This is from Seth Golden's commentary on this chart that Bank of America did. The one that started is only up 733% compared to prior secular bulls at 1159 and 2353. So a long way to go, somewhere from double to triple from these levels. And I think that's going to play out between now and 2030 to 2032. Unbelievable opportunity. I mean, there will always be things to do because you always have sector rotation, but the hangover from the once-in-a-100-year event with COVID has created once-in-a-generation opportunities that we've taken advantage of and our clients have taken advantage of, and we are going to multiply capital like it's going out of style prospectively. And the Googles and the Amazons and the Intels are going to look like chicken feed compared to what's coming. China 1 year prime rate, so that continues to drop. That will eventually kick in, and everyone will say, what happened? They're doing these easing by 1,000 cuts, but eventually when it finally all kicks in together and then price goes up and opinion follows trend and sentiment turns, we've covered this over and over. Rising shipping rates can push Chinese producer prices, so they'll get out of their deflationary period. Demographics are a tailwind for housing demand. We've covered that before. UK retail sales starting to climb up in fits and starts. That's the way that recoveries happen. NASDAQ composite relative to Russell 2000. When was the last time you saw this extreme? Right before when? 2001, when small caps had their biggest rally ever from 2001 to 2007. Same thing happening. Same thing with semiconductors, etc. Equity flows into small cap funds. We said, we'd have to have a check back on that basis. Here is the destock restock cycle. Continues to do exactly what we anticipated when it was down here. It's getting back to the even line, just like it did in 2010, just like it did in 2001. It's right on track. All these things are happening. New orders to inventories ratio, proving that out. Korean exports proving that out. Rail freight car loads proving that out. China accelerated procurement of semiconductor manufacturing equipment since the export ban in October 2022. That was a lot of pull forward for NVIDIA as well, for everyone who got in at NVIDIA at the top. This is part of the reason you're seeing pain. Part of the other reason is the Mag 7 that hoarded it against competition is now worried about how are they going to generate the revenue to substantiate the capex. And as much as they want to spend, the market told you what they think about that when you saw the results of Alphabet. Q2 is expected to be first earnings growth for the other 493, which we talked about. Rent returning to pre-pandemic levels. So look, we just want to get all the data so that you can get a sense of kind of what goes on under the surface of our analysis, because we lay out these roadmaps and it's like, wow, that's amazing. How's it going to happen? Well, this is just like 10% of what we think about. What we say is the tip of the iceberg of what we do behind the scenes to formulate these views and get position for our clients. And so I want to just share some of the data that's accessible for the public that you can see for yourselves and why we think the way we think. Stocks outperforming the S&P at historic low. When's the last time you had the percentage of S&P members outperforming the index itself drop below 20%? The last time you saw anything like that was when? 2000. What happened the next 5 years? The 493 emerging markets, China, small caps all outperformed. So I'm just trying to burden this amazing audience with the facts so that when and if you find this information helpful. Number one, none of this is advice. This is opinion. We only just come on here and share what we're doing for our sophisticated accredited investors, family offices, and small institutions. You should consult with your financial advisor and see what's appropriate in your situation. And if you are an accredited investor, and in which case we are able to be helpful in that regard as well. Slowing shelter costs, okay, owner's equivalent rent coming down, end of destocking cycle bullish for stocks. We've covered that ad infinitum. Disposable income outpacing inflation since the pandemic. That's a key thing. Labor market is not fully cracking yet because the SOM rule implies a recession. We're not quite there yet, but I think the Fed is cognizant that we're getting close, which is why a lot of people are starting to think maybe they go in July. I would love to see it, because if they go in July, then they're definitely, in my view, probably only going to need 1 to 2 cuts. If they wait to September, it's probably 2 to 3. If they wait for December, it's probably 4 if they're lucky, 6 to 10 if they're unlucky, which means they waited too long. National team ETF inflows the highest since stock market rout. So the China government is in buying stocks, taking supply out of the market. So when things turn, they'll turn hard. Here's from RBC, Slumer, Russell 2000 monthly, completing a longer-term cycle with a lot of room on the upside here. This is the relative performance to the S&P 500 has not gotten this low since, again, 2001. We're just breaking out of this, year and a half consolidation. By the way, so many things are doing that. Biotech took a year and a half to make the base. Now it's breaking out and taking off like crazy. Small cap, same thing. And China, the same thing. Alibaba's doing the exact same thing. And when it flips, it's going to flip all at once. It's following the pattern, the mammoth sentiment pattern that we've covered 100 times on the podcast. It's like drawing it out perfectly. And I know we're getting close because, in weeks like this, because it shot up to 80 and now it's 75, I get 100 stupid questions about BABA because people are just impatient. And but I'm going to answer them because I want people to see, and there are no stupid questions, but I have indicators, there are important contraindicators. When I see sentiment concentrated, is usually on the cusp of the next big move, when everyone's asking ridiculous questions that have no bearing on how much cash they generate, how much earnings they generate, how much revenues they generate, because they're fixated on price, which is what pushes them out at the lows and then gets them to buy back up at 150, and then it drops to 130, and then it goes to 200, they buy 200, goes back to 150, they sell in the hole, and then it goes to 300 without them. And so they lose like 3 times because they don't know what they own and they're unwilling to do the work, and they have big screen TVs instead of big libraries, and it's sad. But anyway, Russell 2000 breaking out. We saw that. That's the daily. It ran up against that Fibonacci extension 161, so it'll consolidate for a little while before moving higher. Everyone will say it's over. It was a fake out again, and that's when it goes to all-time highs. Emerging markets, same thing. You can see here, ladies and gentlemen, 2 years to fill the base, plus years, and now it's breaking out and it's going to go, and everyone's going to say what happened, and then they're going to buy it up here, and then it's going to check back to here, and then it's going to go. Tokyo Stock Exchange rolling over. We've covered that. Hang Seng, here's where we are, ladies and gentlemen. So everyone got excited and sold off. Then it had a great finish. And then since the end of the year, it's been just coming down and everyone's depressed again. But what is it doing? It's coming back to the low end of this range, just like it has to. Why? Because all the idiots got in up here that didn't want to buy down here. And they're not going to want to buy down here. They're going to want to sell because they again, got up here. They're going to sell down here. And then they're going to buy way up here, and it's going to come back again. And that's just the way it goes. 10-year yield rolling over according to plan, which we've laid out. U.S. dollar starting to weaken. That's going to be more next week when the Bank of Japan hikes. We believe that's going to happen finally. Pretty nice drop in the U.S. dollar in the last few weeks. And we covered rail freight cars. We covered performance in election cycles. So I do think that you look here, June, July, August. So if people are like, oh, do you want to hedge, blah, blah, blah. Number one, we're not affected by this sell-off because we've actually been making huge gains in the last handful of weeks because we're in largely the non-magnificent and things outside of that, while the markets have been getting smacked, like the most crowded trades have been getting smacked. What are the most crowded trades? Well, they were long mag 7. We're not getting smacked by that because we took off a lot of our Apple and Google. We still have some, and we're going to probably buy back at lower levels. What else was the most crowded trade? Short the yen. Well, that's starting to rally. That's going to be more next week if Bank of Japan pulls the trigger. Short Chinese equities. They're bubbling. They want to go. They're not ready yet, but when they go, they're going to go all at once. And then the last one is short small caps, and that's already started to work. So pretty exciting on those fronts. And then money market funds are still super duper high, so there's still some opportunity there that's going to have to chase as rates come down. It's going to have to go into higher risk assets, and that drives all of this money is going to be the driver behind 2024 to 2032 when we double or triple in the S&P 500 in our view. China Economic Surprise Index finally turned up. This does this out of all sell downs like 2011. So 2009, then 2 years later. 2000, then 2 years later, it bottoms, goes and checks back in 2012, and you have a multi-year rally. Similar situation over and over. This from Jay Capel, looking at value to growth. He's talking about a triple bottom here, and value starting to outperform. Same thing with Russell relative to the NASDAQ, all the things we've been talking about. And finally, which is kind of interesting, It's not final, actually. We got more. Sellers are slashing prices at the highest June rate on record. So 19.8% of active listings have price drops on them as of June 2024. We haven't seen this in a long time. Japanese yen rolling over. Yen advances for the second day ahead of Bank of Japan meeting next week. And I think that's it for now. On to some updates. Boeing sees 20-year commercial jetliner market almost doubling. I love Boeing slowly climbing up in the background while no one's paying attention to it. Elliott took a stake in Starbucks, which is really, really interesting. I know that's been a Ask Me Anything question for a lot of weeks on this. We'll keep an eye on it. This one, there are three. Basically, Nike, Lululemon, and Starbucks. So we'll keep an eye on these. We're willing to have errors of omission, but we're cognizant of the potential opportunities there. Big tech shares lose luster as U.S. market rocked by violent rotation. I mean, I could have written this headline a month ago for you, and here we go. This is a research note from Bridgewater talking about the life cycle of market champions. And this happens over and over, this level of concentration, and it never lasts. And this time will be no different, and you can read the data there. China surprises with rate cut after Xi's big meeting disappoints. China's housing may get extra help by July's end as policymakers strive to reverse the slump. So they got the big Politburo meeting coming up at the end of the month, so maybe we'll get some more announcements there. China's bond yields test PBOC intervention zone after surprise cut. So they continue to cut to stimulate, but they don't want bonds to get bid, so they're trying to defend against that. Xi vows to rewire, and we talked about the impact of China bonds relative to U.S. equities about a month ago. And if they start defending that, that will be those inflection points when they actually come out aggressively defending it is when equities start to just take off overnight. Xi vows to rewire China's finances, helped by indebted regions. Boeing to sell up to 50 airplanes to Korean Air and up to 20 planes to JAL. China extends tariff exemptions on certain U.S. goods until February 2025. General Motors shares slide despite raising full-year outlook. So a lot of what's happening, and this is why we want to be in the Intel business and why we want to be in the Cooper Standard business versus the NVIDIA business and the GM or Ford business. And the reason is we want to be the arms dealer. We do not want to be stuck in the middle of the war. We want to be selling to both sides. And the fabulous businesses, the designers like ARM Holdings, like NVIDIA, like and some of the others that everyone's chasing at all-time highs, are ultimately going to be destroying each other. And there's going to be a duopoly in place between Taiwan Semiconductor and Intel. The difference is Intel is backed by all the Western governments for national security reasons. So all of the major companies are going to be pressured to push their business through Intel, in part because Intel is financed by the Western governments, and they're going to do it under the banner of national security. So effectively, Intel is going to be the fab monopoly for the West. And they'll sell to NVIDIA, they'll sell to ARM Holdings, they'll sell to everyone, they'll produce for everyone. And if you doubt it, just think about all the shorts who bet against the government backstop for Tesla for all those years. The subsidies built the entire company and made Elon Musk the wealthiest man in the world. So Gelsinger, if he's got enough equity, is going to make a tremendous amount of money, and we want to be along for the ride. As far as Cooper Standard, what we said had to play out in the thesis will be that prices start to come down in cars, which we're seeing in the inflation reports. Inventories go up, which leads to incentives, which leads to a race to the bottom for the OEMs. But what happens in the race to the bottom for the OEMs? As the prices become more affordable and the inventories get big and the incentives get bigger, people with the average age of the car on the road is over 13 and a half years will have pent-up demand. And like generators, when your neighbor gets one, a new generator, you want to get a new generator, and you don't want to be the idiot sitting in the dark when the power is out. It's the same thing with new cars. And we've been in a new car dearth for a long time, and we're going to turn into a new car explosion like 2015 to 2007 when the stock traded up to $146, earning $7.19 a share. And the same thing's going to happen. So when people read GM's doing bad, that's GM's problem. They are going to, that's fine, but the volumes are going to be bigger. Their profit margins are going to be smaller. Wall Street doesn't like smaller profit margins, but the volumes are going to be the name of the game for the Cooper Standard, which is why we're playing the derivative plays and playing 3D chess versus checkers, which is chasing the shiny objects and getting your head ripped off, like most people have seen in the last few weeks chasing the Mag 7. These cheap stocks could get a tailwind no matter who wins at the White House. I think they're talking about small caps and infrastructure again. We already covered that chart. Boeing gets a flurry of orders at the international show. PBOC cuts rates in advance of the Politburo meeting, which we covered. Boeing resumes China 737 MAX deliveries after 2-month halt. No one really talked about this. And Nelson Peltz, Trian, took a stake in Solventum, which we own from our ownership in 3M. We got it for free when we bought 3M at much lower levels, and we talked about it on Charles Payne, making money with Charles Payne on Fox Business, and everyone thought we were crazy, and it's played out. Google's parent ad sale growth slows as AI investments soar. We covered that. Yen surges as traders bet the big turning point is finally near. We've been talking about that. Japanese population falls at its fastest pace in demographic crisis. I've told you don't chase Japanese stocks. There are exceptions for multinationals based in Japan, but don't do it. It's just all it was a hot money trade. There's no backing in demographics. Japan business service prices jump, backing case for rate hike. China unexpectedly cuts one policy rate by most since 2020. Magnificent. By the way, that's interesting. They cut the policy rate the most since 2020. And if you remember the parabolic move they had from 2020 to 2020, late 2021 to 2022. Magnificent Seven stocks see worst drops since launch of ChatGPT, with 1.7 trillion value erased in 2 weeks. Okay. AAII sentiment survey backed off, the bullishness backed off a hair this week. And then Rotation Nation stock market and sentiment results. Article of the week. In last week's important note and podcast, VideoCast, we covered everything that was finally going up in line with the imminent sea change we began talking about publicly since late June. Now we are seeing the second piece of the puzzle with Magnificent Seven stocks and NVIDIA underperforming the rest of the market. Looking at the above chart, you can see that while the Mag 7 became the new pain trade since our article on June 20th, you should go to hedgefundtips.com. First off, click on terms. This is opinion, not advice. And then click on this article, the new pain trade, when NVIDIA was at 139, and we said that it's gotten too crowded and it's going to unwind. Well, we saw a 23% drop in NVIDIA since. And while that was happening, Mag 7 and NVIDIA were rolling over. Small caps rallied 12 some odd %. So it's just playing out according to script. And if you're wondering, seasonally, everyone's going to get, I think, in the next week, super bearish. Maybe we're there already, but probably a little bit more. Markets have a tendency not to top in July, but after a summer strength, you do get this weakness here in election years going into August. Where I would start to get interested in doing tactical hedges is if we really have some meaningful strength through October and September, going into that September-October period before the election. We might put on some tactical hedges for clients and build up some cash so we can just go hog wild if we get this weakness in October, and then we get the monster year-end rally. Will give us some extra juice and extra alpha into year-end, which would be awesome. So just want to congratulate everyone that came in the last week and a half. We are closing out the Q3 raise for the smaller accounts, the 1 million plus accounts. We're going to close that out on Saturday. Some of you, unfortunately, I haven't been able to get back to yet. I will get back to you, and if I don't get back to you before Saturday, I'll extend it to you, and we'll get you in by Monday or Tuesday. For everyone else, if you have submitted your information here at Money Management so we can have a conversation, click on the link at hedgefundtips.com, Money Management, and we'll have a conversation to see whether it's a fit. As long as you enter your information by Saturday, by the end of this week, you will be eligible to come in if we have a fit for Q3. For everyone else, if you miss it, we'll probably reopen in Q4 for the smaller accounts, and for the larger accounts, 5 and 10 million, you can always contact, and we make the timing at your convenience when you want to come in. Communication services earnings have been revised down. This is what we've been talking about, the rotation, deceleration in Mag 7, acceleration on Magnificent 493. Same thing with tech earnings, revised down 3% for this year, 3% for next year, a little bit more. While overall earnings with 14% of the S&P, now this is a little more, having reported, expectations were for 8.9% earnings growth this quarter. It's at 9.7%, which is a beat. It's not a meaningful beat, but it's a beat. And that's that. So we want to see the inflation numbers tomorrow. That could be a key component. And then the FOMC next week is another critical key component. So let's, first off, for those of you who don't like the Ask Me Anything question, the podcast is over. For those of you who want to stick around for the Ask Me Anything question, this is when listeners and awesome long-term supporters also send in any question, ask me anything, and we spend time going through different companies, etc. Stick around. We're going to do that right now. So let's get to the first question here. Comes from, okay, that's a client request. Yeah, so this person that just came in, interested in investing, I'll be in touch with you certainly by Monday to get you in. Everyone else has already gotten in. But if you don't hear from me by Saturday, don't panic. You got your form in on time, and you will be able to come in this quarter if we have a fit. Paul Falcone, you always preach about buying at a good price and having outs. Well, a couple examples and maybe future opportunities in EW, that's Edwards Life Sciences, and Dexcom, both fell 30% after signaling stalling growth. Both are good companies, but kind of one-trick ponies, which carries a specific risk if you don't know the business market extremely well. Just thought I'd share some of your Thomisms have helped guide me. Keep it up, Paul. All right, so I don't know if there's a question here. Edwards Life Sciences. I mean, this is historically a great business. I don't think he's asking a question, so I'm not going to spend time on it. If this is a question and not a comment, then put it in for next week. Dexcom, I'm probably a pass. Edwards Life Sciences, I'm kind of interested because I did see that it is a great quality business. I do like seeing it getting smoked because you don't often get too much time. So what you'd have to figure out, and what's worrisome is the free cash flow here, but what you'd have to figure out is this a temporary impairment or a permanent impairment? Negative free cash flow is not what you want to see. Revenues continue to grow, fine. Margins are compressing. So what segment, why is it temporary versus permanent? But I think, Paul, and you've been spot on with a number of your ideas over the years, and EL is on, not EW, is on our watch list. But we're not ready to do anything yet, and may not do anything at all. So I'll leave it at that. If you want to do a serious question like analysis, we can dig into it next week. This is from Franz Mueller, from Germany. Can you take a look at Varta, prominent German battery manufacturing, and I don't think they will go bankrupt. Varta, VARTA. Well, they haven't generated positive cash flow for 4 years, so I don't know what gives you confidence that they won't go bankrupt, but I don't have the same level of confidence. Yeah, they just know how to consistently burn cash. Maybe that's changing, but let's take a look at the balance sheet and see if they have got any time. So they continue, their cash is down from 275 million down to 42 million. But they've kept their debt under control, so that's good. Type of batteries do they make? Household batteries, lithium power. I'm going to pass on that, Franz. I mean, I understand why you're looking at it. It looks like a great trade. It's down from whatever it's down from $200 down to $2. But tell me why they're going to turn around. They're just consistently losing. So let me just take a look at the revenues. Income statement. So they must have done a big acquisition, and now even the acquisition revenues are decelerating. I don't like this. I don't want to play. This is too hairy. Hard pass for me. But thank you for sending it in, and hello to Germany. Okay, so now we're going to get a ton of these BABA questions because the BABA price shot up to 80, and now it's back to 75, and everyone's getting a wrinkle in their panties. So, hey Tom, was wondering if we would see some weakness in the Magnificent Seven. Would that be positive for emerging markets and China in particular? My thinking is that if the institutions are selling something that they may consider overvalued, they will look for something undervalued, and we can all agree China is undervalued. Please let me know how you're seeing this. Okay, so this one's not a whiny one. This is from Luke Waters. That's a good question. Walters. Yeah, it's going to eventually go there, but it's going to go there aggressively as price starts to move. So it won't go there immediately. And we also don't think that the Mag 7 is going to completely crash either because there's free cash flow generation. And they've come down a lot. But I wouldn't think about it in that way. I would think about it more in terms of the dollar, in terms of the Fed, because emerging markets in China tends to do all that. And then finally something, the thing about it is this. We've got an amazing call option, and we don't know what the catalyst is, and we can't predict what the catalyst is, whether it was the third plenum meeting. And by the way, they put out a lot of stuff. The reason the market didn't like it is because they wanted them to be clear. And they keep doing these piecemeal things. But eventually, all of these piecemeal things add up, and when it all clicks, it happens quickly. So you're not going to be able to predict the catalyst. But what you can control is the business you own constantly improving the fundamentals. And if they constantly improve the fundamentals, and by the way, you get a 4% yield from buybacks and dividends while you wait, with $80 billion of cash as security with your downside covered and a lot of outs, then you have nothing to lose as long as you're not on leverage, which we talk about all the time, and you just play the time arbitrage game. And if you've got a basket of 8 to 12 to those, some of them, reach fully valued in less than a year, which is the exception. Some of them take 5 years, which is also the exception. Most of them within 2 to 4 years, you reach your multi-bagger with a well above average IRR, net of fees, and everyone goes home with a smile. So thinking like it's a binary, they sell out of Amazon and they buy Alibaba. There's some of that, but that's a function. That's checkers. The chess is what drove that. And what drives that is the carry trade unwinding and the money coming out. And then it has to find new places to go. And, right now it's finding small caps and it's finding some of the other things. But like 2001, it will eventually find its way back into China. And the other thing is that Alibaba had its biggest move in history under Donald Trump. So for those everyone's afraid Trump and Vance hate China, Trump is a pragmatist. He's a commercial deal maker. He is not an ideologue that wants to punish people for the sake of punish people. He just wants to figure out how he can get them to make us money. And once they agree to do that, and Xi understands that, and historically understand it, you get moves like you saw from 2016 to 2018, which was unprecedented, and it was under Trump, Mr. Anti-China, because he's a pragmatist, not an idealist that wants, to do things for the sake of doing them versus doing things that are actually going to be helpful. Nico Jovic, and that's, by the way, not a political view. That's just an empiric view of what happened with that particular one policy execution. I'm sure those of you on one side of the fence versus the other side of the fence, and if I'm doing a good job, you shouldn't know which side of the fence I'm on, could present 10 policy directives of the previous administration that weren't as good as their framework yield with China from 2016 to 2020. So I'll leave it there. Nico Jovic, quick question regarding Alibaba. I was wondering if you feel like the worst case scenario is that China is evading Taiwan, delisting, market share loss to Temu, communism not allowing the company to do what it wants with its own assets is all priced in. Well, the fact that you know about it tells me that it's all priced in. What else do you want to know? I mean, it's effectively, if you were to liquidate the company today with cash and fire sale values of the different businesses, assuming zero growth, you'd probably get $150 to $200 a share. And if you assumed recovery of growth, which no one is at the moment, you'd be looking at 200 to 300 to plus. And then you add a little exuberance on top of it, you get more. So the reason I'm asking is I'm looking at the Alibaba and ask myself who's left to sell. Wouldn't all the weekends already be out by now? And also, what do you think needs to happen for Baba to? You can't predict the catalyst. What you can know from decades of doing this is the catalyst will come. Good things happen to people who buy undervalued assets. It's just inevitable. And if you can even add a word, undervalued high quality assets, not cheap for cheap's sake, but cheap for temporary impairment due to all these bullshit headlines that everyone's reading, that you're reciting here, that everyone knows and is known, which means it's priced in. I would be worried about what we don't know that we don't know that's not priced in. And I think in this case, the worst case scenarios are in fact priced in. I don't think the worst case scenarios are priced into Apple if China invaded Taiwan and delisting. But we've gone through all these a million times. It's irrelevant. The key is they continue to grow cash flow. They continue to grow revenues. They continue to grow earnings. Thanks in advance. I share my VideoCast with all the colleagues who are interested in investing. Greetings from Serbia. Okay. Well, thank you for calling in from Serbia. Nico, I think you're on the right track, my man. Thanks for calling in. All right. David Blumenthal. Thanks for the amazing content every week. Would you agree with the fact that in order for Alibaba, so by the way, this is Alibaba week. Whenever we get all these, we're probably going to get a nice announcement next week. Would you agree that the fact that in order for Alibaba to get bid higher, we would need U.S. institutions to come in and buy a large amount of stock? No, I wouldn't agree with that. It will happen, but that's not the core catalyst. It hasn't happened in the last 2 years. What makes you think it'll happen in the future? Do you think the opening of mainland China will see enough inflow to push it higher? How much inflow are you expecting from the 180 million people? More than from zero. Let's just put it that way. That's about a round number. Slightly more than from 0 people who currently are now not allowed to buy Alibaba stock. 180 million people being allowed to buy Alibaba stock might have some value. So we'll see how that plays out. But at the end of the day, all I can control is that the fundamentals are going up, and soon the price will catch up to underlying value, and or it won't be soon, but I'll have no leverage, and by the time it does, like we went through the BYD thing where they had 3 drawdowns of 50 to 80%, Charlie Munger and Warren Buffett, and then in the 11th year it went up 20x or whatever it was, which turned out to be a 30% IRR over whatever it was 12 years that they were in, and they've just taken all of it off the table pretty much. So I'm fine with that too. This will always have a position until it's too expensive. That's what I can tell you. All right, moving on. Thanks for tuning in, David. Devin asks, can you look at RNW, Renew Energy Global? Seems to be a long-term energy play with financials getting better and better. Okay, just what I want on a Thursday night is a renewable energy company. Makes my heart sing. All right. All right, so they had this big growth from 92 million to 900 million, and they flattened out for the last couple of years since. Break even to slightly making money. Let's take a look at cash flow. So this is easy. They burned $1 billion of cash last year. I don't really need to know a lot more than that. All these renewable companies, it's the same nonsense. $6 billion of debt, $500 million of cash. No thank you. Hard pass. But thank you for tuning in, and keep listening, because in 3 months to 6 months, you're going to be sending us amazing names that are actionable. I see the trading pattern you're looking at. Maybe you can make a trade out of it, but that's not for us. But thank you for listening and sending that in. Kyle sends, just a quick question regarding the China sentiment. It seems that every day there is positive news about China and their new policy, but it doesn't seem to translate in the indexes or individual stocks. What's the reason? We don't know. And that's all you can say. But what you can know is that if you buy quality businesses that are growing earnings, revenue, and free cash flow, sooner or later, the headwinds will clear and they will reach not only full value, but excess value. And the same despondency that you've seen as it built a base for 2 years will turn into euphoria when it hits absurd levels that are eons big. The key headlines you're going to see in whatever it's going to be, 18 months, 2 years, when the stock is trading at very high levels, is people are going to say China is going to that's going to be the last thing. Their parabolic move, just like Japan in the late 80s, in the land of the rising sun, if you remember, right before they hit their demographic cliff, just like China will in 5 years. People are going to say, see, China is going to overtake the U.S., and they're going to say the 21st century is the century of China, and they're going to be dead wrong. And when we see those headlines, and China and Alibaba has a high 2 handle, low 3 handle, we are going to be sold to you. And what's going to happen is we're going to sell a bunch at 280, we're going to sell a bunch at 300, we're going to sell a bunch at 320, and then we're going to keep a little trailer on of 10% of the position. It's going to go to 350. Maybe, we'll see. And then I'm going to say, what, this is just insane. Like, this is well beyond any of my wildest dreams when we got into the position. And we're going to take it off, and it's going to go to 400 and probably 425 when it gets every last schmuck in before it falls back down to 50 10 years after. So, the answer to your question is what we've been saying all along, is all you can control is your framework. You cannot control when it turns, but the longer what I have found throughout all these years is the longer it takes to turn, when it finally moves, the move is more abrupt. And just like Charlie and Warren saw with BYD, which we covered a few weeks back, go back to our articles of the week on hedgefundtips.com, is for them it took 10 years. And then, 20-something bagger in a year, 30% IRR compounded over the whole holding period and sold to you when the euphoria hit in. Same thing will happen here. So not 21 bagger, because you have much less risk than they had, but when it moves all at once. Okay, next one is... this is hard. I'm working off of. All right. Can you give an example of a time when you invested in a company and ended up being a losing position for whatever reasons, not knowing what you could have known? What did you do in the situation? What did you learn from it that made you a better investor? I don't get into situations. I mean, my number one thing when I get into a business is solvency risk. Okay. And then the second thing is sizing. So if there's something that I don't know that I don't know, and it goes to zero. But the best example, and we've talked about it a few times on the podcast, was Range Resources. And I got it in 2018 at $11. It had fallen from 90. And it immediately went from 11 to 18, and I thought I was a genius. And then it started drifting down, and then COVID came, and it dropped all the way to $1.16. So what did I do when I was wrong? I was down 90% on $11 basis. Is very simple. I bought as much as I could possibly buy in the hole and brought the basis down from 11 and change to 4 and change. And today, and we still own it, by the way, and today it's 36 and change. And we'll sell it when it hits intrinsic value, which is up from here, because when we did the liquidation value back in 2018, it was north of $60 a share. So, so we originally thought it would be a 6-bagger. And now, from a much lower basis, it's probably going to wind up being a 15-bagger because we're patient while everyone was puking in the hole during COVID, and no one would ever need natural gas again, and oil turned negative, and all this bullshit that people get caught into that forces them to sell at the exact wrong time happens over and over. So yeah, so it went 90% against me. It wasn't 100% of my portfolio. That's why you have 8 to 12 positions. And now we're up huge on it, and we're going to be up huger. To put that in a word that makes zero sense, except when you've been sitting in the sun for 8 hours watching the most exciting water polo of my entire life. So incredibly proud of the team. Our goalie was so unbelievable. This one girl put away so many. Mimi had a goal this morning. So proud of that. I'm not going to force you to watch it as I play. But the team and the coaching, unbelievable. I mean, the coach was so passionate and intense. I mean, this 8-7 win was just a game that these girls will never forget their entire life. I mean, it was huge. So we'll see if we can carry it through to the end of the tournament, but that alone was worth the whole trip. And that was a good question, Paul. Thanks. All right. Adam Dyer. Not sure if you remember me. I send you some IBB versus FBI. Lockheed Martin. Okay, so he's been around for a while because Lockheed's had a huge run. He asked if I still like it. And it just continues to go up. So, yeah, I like all defense stocks, but I'm expressing it heavily through Boeing. He goes, maybe time to sell at the peak price or recycle into GXO and PayPal. I can't speak to that. I think Lockheed's fine, but as far as value per dollar, yeah, look, the good is always the enemy, the better is the enemy, the best. Why does it have to be binary unless you own too many stocks? You could keep that and add one of those, but obviously we like GXO and PayPal, and we own GXO and PayPal, so I won't say any more about that. But congrats for getting in and riding the wave. Sam R., what makes China different to other emerging market countries that don't seem to get as much negative attention? Well, it's been the government policy, but it's always something. Okay, so he's saying Turkey seems to be loved. Yeah, it wasn't 3 years ago, now it is. So China will be the exact same thing. It just runs. Stop worrying about macro. You're not going to make any money. You're not going to outsmart anyone on macro. I guarantee you. I'm pretty damn good, and that's not how I make my money. I make my money not predicting macro. Like, by the way, some of these calls that I've made in the last few years have been unbelievable. But the money is made in buying high quality businesses when they're on sale. And that's how you ultimately make big money over time. You pay attention to the macro, and the macro guides you, but how you make money is doing the breakup analysis of Range Resources, the liquidation of proved and unproved reserves being worth over $60. That's how you make money. And then when the price doesn't agree with you because a once in a 100-year event happens, do you puke out in the hole down 90%, or do you load up the position because it's Christmas in 2020 and you can buy a business that's worth $60 on a normalized basis at $1.16? And you know the answer to the question, but most people don't. And most people will get caught up in emotions and headlines and bullshit that separates you from your ownership in incredible businesses at the exact wrong time. Sam R. We did that one. Okay. Kyle. All right, here's another crazy question. I was wondering if I'm right about the observation that Alibaba has a 1-to-1 correlation to the Hang Seng Index. Every small rally Alibaba has in the last year, the Hang Seng has bid up to. What is necessary for Alibaba to have an independent rally? You're not going to need an independent rally because when Hang Seng goes up, Alibaba, over time, in the short term it won't because Alibaba's hated, but in the intermediate term, when the foreign flows start to come in, they're going to want the highest quality asset because they're still going to be skeptical of the country. Alibaba's going to start to outperform the Hang Seng, and then everyone's going to want it, and then they're going to actually get some good news that people pay attention to, and then it's just this benevolent circle, and then it will be overbid, overpriced, over everything, and we will be saying sold to you. Okay. And Kyle, I got your question the first 2 times. You don't need to send it a third time. And that's a investor coming in, and that is an investing inquiry. Okay, great. So we're done. We'll be back next week live from the East Coast. In the meantime, make it a great one. Bye for now.